So today we have a guest who is an expert in VA home loan mortgages and the Streamline refinance option. Super excited about this. The VA home loan is one of the most widely, one of the benefits that people are most eligible for. It's one of the kind of lowest hurdles, if you will, to get access to. So it's an amazing benefit. It is something that probably everyone at some point will do, which is buy a home, and we talk about it in context of the transition from the military, which is kind of a tenuous time. So, Mike, anything additional to add?
No, I definitely listen. I think you're going to enjoy it, and I learned a lot, so I'm sure our listeners will also. So sit back and enjoy this episode.
Welcome to Operation Retirement Readiness, where Amy and Mike, two certified financial planners, talk about how military members can prepare for transition and how veterans can prepare for ultimate retirement. This podcast represents the views of the hosts and any guest. It is for informational purposes only and should not be considered tax, financial, or legal advice. All information is regarded to be from reliable sources. The hosts are not responsible for any losses, damages, or liabilities that may arise from the use of this podcast. This podcast is not intended to replace professional advice.
So, today we're going to continue with our interviewing of experts. Today we have Brian Willingham to talk with us about VA mortgages and Streamline refinance. So these are topics that tend to come up quite a lot, particularly when with interest rates on the move, but especially when you're getting ready to retire. So Brian, why don't you tell us a little bit about your background and a little bit about what you do now?
So I was born in Maryland, born and raised in Maryland, and enlisted in the Marine Corps in 1993. Served for 4 years and got out. Went back to Maryland, went to University of Maryland, and graduated from there with a business degree. Did a few things here and there, and then found my way into the mortgage business in 2002, and I've been doing that ever since. And finally started my own company almost a year ago today, called Mission Mortgage Company. So I'm an independent broker owner of Mission Mortgage Company.
Awesome. Congratulations on the soon to be 1 year anniversary or about 1 year
Thank you.
anniversary.
Thank you.
Yeah, that's awesome. A lot of different options out there for mortgage financing, VA being one of them, but there are also some others. Do you mind giving us a little comparison and contrast of what kind of the difference is and why somebody might consider, using their VA benefit?
Sure, sure. So in general, you've got VA loans, conventional loans, and FHA. And 99% of people are getting one of those three, and typically it's going to be a 30-year fix. So all of them have 30-year fixed rate options or shorter or adjustable rate options in some cases. But for active duty and veterans, for people who qualify, VA is generally going to be the best deal out there. It's got a couple of big advantages. Number one, for most people, it's not going to require any down payment. Even with no down payment, there's not going to be monthly mortgage insurance on the loan, and the interest rates are going to be typically better than conventional, similar to FHA, but FHA's got a lot of mortgage insurance. So VA loans with that combination, no down payment, good rates, no mortgage insurance, generally going to be the best deal for people who qualify for them.
Is that rate piece where VAs are, the best? Has that always been the case? Or is there, I sort of remember, I think one time when we were looking for a house that, you know, VA was a little bit higher, but now with our last house, it was a little bit lower. So I'm just curious if that fluctuates some or if that's now kind of the general rule.
Um, it's been the case as long as I can remember. Early in my career, so early to mid 2000s, I didn't do a ton of VA loans. Actually, didn't understand them at that point. So I'm not too sure where the rates were back then. One of the things that I do see a lot though is that VA rates should be better in most cases than conventional. Conventional, there's a lot of things that affect the interest rate though: your income, credit scores, down payment, where you're buying, and your income compared to the average in that area. All those things can make pretty significant differences in the interest rates. So for some people, conventional can be fairly competitive with VA, but also a lot of banks, for whatever reason, will not offer the lower rates on VA that they could. I've worked for banks like that before, and that's kind of where I learned it is some banks will offer similar rates on VA as they would on conventional, and that just makes VA more profitable for them. But in general, if you're doing an apples to apples comparison, VA should have better rates than conventional in most cases and should be pretty similar to FHA. Like I said, FHA, there's a lot of mortgage insurance on those loans. So VA generally will beat those out.
Okay, yeah, that makes sense.
And I'm glad that you brought up, and you know you kind of said you early in your career you didn't do a lot of VA mortgages, and said you didn't understand them. And I'm actually glad that you said that, because the point there is that they are, you need to work with somebody who understands a VA loan, right? So can you just talk to us a little bit about, when it comes to finding a mortgage, um, how you might choose one lender over another lender?
Sure, sure. With VA is kind of a whole different animal in the mortgage world. It has a lot of similar rules to conventional and FHA, but it also has a lot of very unique rules, whether that's who's eligible, what kind of down payment is required, or just some of the standard underwriting guidelines like debt to income ratios and things like that. VA has a lot of very unique rules compared to the other loan types. And if you don't do a lot of them and see a lot of different scenarios, you don't really know those very well. So I know from my own personal experience, when I got into the mortgage business, the person that trained me didn't really know VA. So I didn't learn them until a little later on when I started realizing all the benefits of them for veterans like myself and took it on myself to learn them. A lot of lenders are the same way. A lot of companies don't really train the loan officers on VA because VA is a lot less common than FHA and conventional. So, for a lot of companies, if you're not going out and looking for VA buyers or VA customers, then you're just not going to do very many of them. And then, as an individual loan officer, if you don't do many of them, you're not going to learn all the ins and outs of them. So it can be pretty tricky. So as far as finding a good lender, interest rate definitely matters. You don't want to pay more than you should for a loan, and there are a lot of good lenders out there that are offering good interest rates. I would typically say if you talk to a lender and you get the sense that maybe they're not 100% comfortable with VA loans or that they don't do a lot of them, if they tell you anything that seems like it might present a problem, maybe double check it with another lender. A lot of people will just go with the lender that their realtor recommends, which is usually a good sign because if your realtor recommended a lender, they probably have experience with them. They know they can trust them to take good care of you and promise or deliver on what they promise, but that doesn't necessarily mean they know VA. They might be really good at conventional and FHA, and they might be good loan officers, but they may not really know VA in and out. So it's probably a good thing to ask the loan officer, how many VA loans do you do? How many have you done in the last year or something like that, just to get a sense of what kind of experience they have with it.
Those are all really good points, and there's something else that I want to kind of draw out, because I didn't understand this before I was in the finance world. Um, can you talk about the difference between going to a bank for a loan versus someone like yourself, where you're a mortgage broker? So you're shopping across, different ways of funding loans, right? Can you just kind of explain that to listeners who may not be familiar with that idea?
Yeah, absolutely. So with VA loans, ultimately the loan is going to be guaranteed by the VA. So every bank is going to follow to some degree VA's rules. Every lender will follow VA rules. Some of them will have what are called overlays, though, where they'll say, okay, VA doesn't require this, but we do. We're just going to be a little bit more conservative on one thing or another. A good example is credit score. VA doesn't actually have a minimum credit score to get a VA loan. So there's lenders out there that will do VA loans down to a 500 credit score. But most banks are going to say our minimum is 620 or something like that. As a mortgage broker, I'm signed up with right now, I think it's 13 different investors that I can send loans to. So my advantage as an independent broker is I'll be your main point of contact. I'll help you all the way through the process, but ultimately I'm going to send the loan to where we can get you the best interest rate, or if there's a lender that has better guidelines like lower credit score limits or something like that, then we can take your loan there. When you go through a bank, the bank is essentially just following their own rules that they've set, and they've got their set of interest rates. The advantage that banks like to talk about compared to mortgage brokers is that everything is done in house. They control the process start to finish, and that is true. And in some cases, working through mortgage brokers, it can be a little bit more difficult if I'm working with an investor that I don't do a lot of business with, or they're not the best on customer service. Maybe we sent your loan there just to get a slightly better interest rate or something like that. That can sometimes add a little frustration to the process where I don't have direct control over the loan. Where at a bank, when I worked at a bank as a loan officer, I could walk down the hall and talk to the underwriter. Now I've got to call somebody at a different company. And so there are advantages and disadvantages. My experience as a broker is that the investors I've been dealing with are very responsive. So that kind of takes away a lot of the advantages that the banks have. But ultimately, with the bank, they are controlling the loan from the whole, start to finish, all the way through closing. After closing, almost everybody ends up transferring the servicing of the loan. There's a whole industry of servicing loans and getting paid for that. So banks like to make loans and then sell the servicing rights to somebody else. So regardless of who you go through up front, it's almost always going to get transferred after closing, no matter who you deal with.
Gotcha. So I think the key takeaway there for listeners is that, if you go to a bank, you should shop several banks. There could be differences between the banks. Or you can have a broker shop other alternatives for you. So I think that's the key takeaway for a lot of listeners. And Mike, I think you have some questions on funding fee, kind of moving beyond the selecting of the lender.
Yeah, yeah, no, no, all great info. But yeah, so one of the things with the VA is the funding fee. Can you talk a little bit about that and how that gets factored in?
So the funding fee is basically what um, literally funds the VA loan program. The VA loan program, last I heard, does not cost the taxpayers any money. It's completely financed through the interest that they earn on the loans and the funding fees. So VA is generally going to charge a funding fee on every loan. The exception to that is if you have any kind of disability rating through the VA, or if you're still on active duty, if you have a Purple Heart, you can get the funding fee waived. Or if you're nearing the end of service and you looks like you will get a disability rating, sometimes we can get the funding fee waived in advance. But the funding fee itself, if you do have to pay one, it's a fee that the VA is going to charge up front. They generally will let you add it onto the loan amount so you don't have to pay it out of pocket at closing. And how much it is will depend on if you've used your VA mortgage benefits before or not, and how much of a down payment you're making. So, for example, when I bought my current house, I was using my VA benefits again, and I put no money down. So the funding fee ended up being 3.15%. That's what it was about 5 years ago. That's still what it is for what they call subsequent use, no money down. So that's about as high as it gets. Most cases, it's going to be that or below if you've never used your benefits before. I think it's 2.3 right now off the top of my head, but so it's a percentage of the loan amount, and then they just add it on to the loan amount in most cases, unless it's waived.
No, that's great. Yeah, and so again, you mentioned at retirement, if it's projected, but if you're buying before you retire, any way to get a refund there, or how does that work?
So I usually not involved in this part of the process, so I haven't seen it done before, but the VA guidelines say that if you were to buy a house and pay a funding fee and then earn a disability rating, if that rating is effective, basically backdated to before you bought the house, then you can apply to the VA and get the funding fee waived. But let's say you buy a house on September 1st and then you leave the service and your disability rating is approved October 1st, effective October 1st, there's no way to get that refunded. You'll never pay it again if you do any more VA loans, but you can't get it refunded. But if they were to say approve it on October 1st, backdated to August 31st in that example, then you could apply to have it refunded to you.
Yeah, that honestly actually happened to me. We bought our house. I was on terminal leave, 1 August, I think we closed. My retirement wasn't effective till 1 November, and that's when my disability was rated back to. So yeah, I didn't qualify for the. I looked at that and I was like, but yeah, if you need housing before you actually, you're officially separated, it gets more challenging. So just, listeners, keep that in mind if you are approaching that window. And now we see it more with folks doing the skill bridge where they maybe even buy in earlier than terminal leave type thing, that you will pay that funding fee, even though, yes, you probably eventually will get your, a disability rating at that point. So just something to keep in mind.
Yeah, one more point on that. There is a process you can go through. I'm actually working on one right now where if you, because most service members have a pretty good idea before they leave the service if they're going to get some sort of disability rating. They may not know exactly what that's going to be. With the funding fee, it doesn't matter how much your rating is. As long as you get, I think the minimum the VA ever gives is 10%. As long as you get 10% or more, then the funding fee is waived. So if you are in the process of leaving the service or coming up on that soon, and you're going through the process of getting your disability claim ready, there is a way that we can take your medical records and submit it to the mortgage side of the VA before you're closing and ask them to waive the funding fee. And they'll basically look at your medical records and say, well, we know this person is going to get some kind of rating. Doesn't matter what it is, but we can tell from the medical records they'll get something. And then they'll give me a new VA certificate of eligibility, which is the form we need to do any VA loan. They'll give me a new certificate of eligibility that waives the funding fee. So even if the disability isn't fully approved yet, if it's in process and it looks likely, we can try and get that funding fee waived ahead of time. So
Sounds like it's
That's
worth,
great. Yeah.
yeah, worth asking about.
yeah,
Um,
it's definitely worth it. In the case I'm working on right now, it'll save them. I think it's $10,000, somewhere in that range. So, and the process itself is pretty simple. It's one form. I fill it out. I send it to them to sign. They send it back to me with their medical records, and I submit it to the VA. The last one I did was a couple years ago. That one took about a week. This one, we're a little over a week and still don't have an answer, but I would expect one here pretty soon. So it's definitely not a difficult thing to do, and the worst thing they can do is say no. There's no fees for it or anything like that. So it's, if you've got the medical records put together and we can submit it, it's definitely worth trying.
yeah, sounds that way. I mean, and trying to buy a home as you retire from the military is a little fraught anyway. It's kind of a challenging time because income changes and things like that. Can you just, sort of give our listeners an idea of why that can be such a challenging time and maybe how to set themselves up for success in buying a house?
Yeah, absolutely. So every situation is different. Everyone's process of leaving the military is a little different. And so this is just speaking in generalities, but when we're looking at qualifying someone to buy a house, if you're leaving the service, then we still have to document what your income is going to be. And that's generally the rule of thumb is any income we need to use to qualify you, we just have to be able to document it. So if it's disability income or retirement income, then we have to have something in writing from the VA that says what it's going to be. And that can sometimes be a little tricky to get right around the time of the end of your service, because unless it's changed since the last time I talked to someone about it, generally you can put all that stuff in motion, but you're not going to get anything official from the VA that says what your disability amount is or your retirement amount until a little bit after you've left the service. And if you're trying to buy a house in that window, that can be, pardon me, that can be a little tricky. With civilian income, it's a little bit easier, especially if you're going into a salary job, because then we just need an offer letter that says what your salary and your start date is going to be. The veteran that I'm working with now on the funding fee waiver, that's his situation. He's on terminal leave already. He's got his civilian job. He starts about a week after our closing, but we have an offer letter so we can use that income. It can be a little more difficult on jobs that are hourly or will include bonus or commission, since we can't really predict what that will be. Sometimes if the company can get us something that says it's definitely going to be 40 hours a week, we can use that if it's hourly, but bonuses and commissions can be tricky. Self-employment income is much more difficult. Generally, we're going to need a year or two of history on that before we can count that as stable and predictable income. So in general, it's like I said, everybody's situation is different. To me, the best thing to do is just start talking to a lender as early as possible. Once you have an idea of what your plans at the end of service are going to be, do you want to buy right away? Do you have a civilian job lined up? Those types of things. Then we can get a much better idea. But it's never too early to start having the conversation, just so you know what your options will be.
Awesome.
No, yeah.
I'm sorry. It's just I was going to say, we do have a lot of service members that end up, wanting to start their own business and things like that, things like that. So I think it's a great idea for people to immediately, as soon as you know that you're transitioning, put it on your list of things to go find is a lender to start talking with, especially if you plan to start a business.
Absolutely. And I've had people that I've talked to uh, 2 years ahead of their discharge and just kind of stayed in touch and worked things through all the way through when they left the service and when they bought. I've had people that I've talked to right before they left the service who didn't end up buying until 2 or 3 years later. So it's like I said, it's never too early to start having the conversations and stay in touch. And as the situation develops, we can adjust and figure out what your options are.
Yeah, that's great. So moving on to kind of the VA loan limits, I know this has also changed, from a while ago, but is there a max benefit that you can use or a max price on a house that you can get, Brian?
So it's pretty easy now if you've never used your if you've never used your benefits before. Basically, VA has no maximum loan amount and no minimum down payment required, regardless of the sales price of the house. So, if you qualify for it and you want to buy a $5 million house and get a $5 million loan, VA says you can do that. That is an area where a lot of lenders will have their own overlays and say, okay, our max is 3 million, or over 2 million we want a down payment or something like that. But as far as VA goes, their guidelines say if you have what they call full entitlement, then no down payment is required as long as you qualify for that loan as far as income and debt and other things like that. Where it gets fairly complicated is if you have used your benefits before and not had them fully restored. So a really common example is someone is on active duty for a long time. They're married, they have a family, they bought a home. Now they're leaving the service, they're moving back to wherever they're from, and they want to buy a house there. They still have that other house at their prior duty station, and they'd like to keep it as a rental, but it has a VA mortgage on it. So they used some amount of entitlement when they bought that house and used the VA loan, and they haven't had that entitlement restored. So now they have uh, some amount of entitlement, but not full entitlement. And when that happens, then there's a formula that says okay, based on the price of the house you want to buy, the county where it's located, and how much entitlement you have remaining, here's your down payment required, if any. Sometimes even people who don't have full entitlement can still do no money down on the new house, and sometimes they have to do pretty decent sized down payments. It all just depends on the amount of entitlement they have remaining, the price, and the location where they're buying. And I thought about this after we were emailing about some of the things we were going to talk about. There's a website where you can plug in that information and it will tell you exactly how much your down payment would be required. And I can send you guys that link and you can put it in the show notes if you want. The trick to that is you have to know how much entitlement you have remaining, which you can, you veterans can get their own certificate of eligibility from the VA website. I always pull them for my customers. It takes me about 2 minutes to do it, so it's really easy for me to. But if someone is a DIYer, you can go to the VA website, get your own certificate of eligibility, and then plug those up numbers into this other public website and get an idea of what you might be looking at.
That's
I would
really
always recommend talking to a lender on that, though, just to double check. It is a little bit of a funky formula, so I would always double check those numbers with a lender before you start making any decisions.
but it's I mean it's a good starting point. And quite honestly, I think it probably happens fairly often, because even if somebody doesn't want to keep the house as a rental, they you know it may take longer to sell than you had expected, and you need a home to live in, so you're going to purchase this home. It's going to close a few months before your other home. That entitlement's still tied up, regardless of what your intentions are with the house. So I think that's
Yeah,
a great explanation, and one more reason why you should talk to a lender sooner rather than later when it comes to transition from the military.
definitely.
Um, Now we've gone over quite a few details about VA loans. We know they're complex. Um, One of the things I kind of want to turn our attention to, and I fully expect that the activity will pick up on this pretty soon. So I mentioned Streamline. The official name of the Streamline refinance is the Interest Rate Reduction Refinance Loan, or IRRRL, three R's, I, three R's, and an L. Um, Typically people are finding these offers in their inbox, and maybe even in their email inbox. Can you just tell us a little bit about what this is and how it works and all that kind of stuff?
So in the mortgage world, we call it an Earl instead of the IRRRL or whatever. So Earl or Streamline are the generally accepted jargon for that. Basically, what it means is if you have an existing VA loan and all you want to do is refinance it to get a better rate, then the VA will say, okay, all you're doing is putting yourself in a better financial position and less risk for us. So we're not going to worry about verifying your income. We're not going to worry about doing an appraisal. And unless you're bringing a bunch of money to closing for whatever reason, we're not going to verify your assets. Some lenders, some of the investors I work with will also do it with basically just one credit score and a mortgage history. They won't even look at anything else on your credit report. So it's really easy. It's not it's not too much more difficult than basically we send you the loan application paperwork to e-sign. You e-sign that, send back 3 or 4 pieces of paperwork like homeowners insurance and a couple other things. The underwriters approve it, and then we set up the closing. We do a title search too, so there's a title company involved in most cases, but it can go really, really quickly, and it's really easy to do. I just closed one in 10 days, so it's super easy. There are some limits to it. VA says you can't do it too soon after you got the existing loan. You have to save a certain amount relative to your closing costs. So there are some rules on it, but essentially, if you're just going from 7% to 6%, it's super easy. And the reason why veterans get so much junk mail about it is because for lenders, it's really easy to do, but they still make money on it by doing the new loan and then selling that the loan servicing or basically getting the guarantee from VA on it. So lenders love them because they still make money on them and they're really easy to do. And that's why veterans get so much junk mail about them. So it's kind of the good with the bad. It's a great option that people have, but you got to deal with the junk mail and the phone calls and text messages and emails.
And is there a ballpark cost on that? Is there or a is there any kind of funding fee tied to that or
So the funding fee is 0.5% unless you have a funding fee waiver. So it's a pretty low funding fee. Generally, you've got some standard closing costs. There might be a lender fee, title company fee, and title insurance. Some states will tax refinances. So they basically tax you on the new loan amount or the difference between the old loan amount and the new loan amount. But that varies significantly from state to state. So it really depends on the loan amount and the state you're in, what those closing costs will look like. What a lot of lenders will advertise, and what I've done a lot too, is what we call a no cost refinance, which is not technically an accurate term, but basically what happens is there's always going to be closing costs, but we can give the homeowner a little bit higher interest rate, and in exchange for that interest rate, we'll pay the closing costs for them. And for some people that makes sense. For some people, it makes more sense just to pay the closing costs and get a better rate. But it is an option that's out there. So if you see any advertisements that say no closing costs, that's what they're going to do is they're going to basically give you a little bit higher rate and pay the costs on your behalf. They shouldn't technically be advertising it as no closing costs because they can't control what the state may charge or the title insurance companies, but they're paying it on your behalf out of the interest rate. And so what we look at in those circumstances is how long are you planning on being in the house? How long do you plan on keeping this mortgage? Does it make sense to pay some fees and get a lower rate, save more money in the long run? Or maybe if you only are thinking you'll be in the house for a few years, let's get you a better rate than you have, but don't don't pay any closing costs. We'll use that lender credit to pay them for you. So every situation is different, and I always try and look at those options with everybody.
yeah, or even if you think, hey, rates may continue to drop, do it, short time and then, keep your fingers crossed that they do go down and you can potentially do it again if it's still lower at some point. So yeah, no, all great points to factor in. So
I'm I'm a little weird in this sense from being in the business. I've done Earl refinances to save 0.25% before, but we use the rate to pay all the closing costs. And when you refinance, there's always the way the numbers work out. There's always a month where you don't have a payment. If you want to structure it this way, you can make it so that you go 2 months without making any payments. So I've done it before where I went 2 months without making any payments, dropped the rate 0.25%, and everything was rolled into the loan. And I still ended up with a little bit lower payment, but a couple months worth of monthly payments in the bank. I don't recommend that for everyone, but it's I say that just to emphasize how easy the process can be. That I, I've done it for pretty minimal savings before, but I also do this for a living, so it's
yeah,
When
easier for me.
I mean, I think your point is well taken is that there's circumstances where that may make perfect sense. Particularly if you are leaving the military, you're not planning to leave the area that you're in. So you own your home. Even if interest rates are just a tiny bit lower than where your mortgage is, it might still make sense if you didn't have enough time to build up your cash cushion, and now you need to give yourself a little breathing room while you find a job. While it's not, the rule of thumb advice, it might be the right answer. And it really kind of depends on your situation. And,
Yeah.
one of the things I want to kind of foot stomp here is because we get so many of these notices, and my clients get a lot of notices. And we've talked about this, Brian, you and I have talked about this, where, lenders will say, your payback is 2 months or something, and it's not quite calculated correctly. So do you have advice for people in making sure that, they're doing proper due diligence in really what the loan is going to cost them and what it's going to save them and when their break even point really is?
Yeah. So one of the things, especially on the Earls, that you see a lot of lenders advertise is really low interest rates, and then they gloss over what the fees are. They really sell the interest rate, and again, every situation is different. For some people, that makes a lot of sense, but I've seen so many times over the years where a past customer of mine will call me up and say, "Hey, I got this thing in the mail. I talked to this lender. They're going to get me 3% and I'm at 5%. Does this make sense?" And it sounds great. And then you look and they're charging $25,000 in fees. And so then it's a different conversation. It's like, well, 3% is great, but are these fees worth paying to get there? So you have to take the whole thing into consideration. Watch how much is getting added onto the loan, because that's the other thing with the Earls is you can what we call roll in most, if not all, of those closing costs when you do them. So I can set an Earl up where someone's getting a lower rate and a lower payment, and everything is rolled into the new loan, but that doesn't mean that's a great deal for them. So especially if there's a lot of high fees up front, some people might be fine with that, and if you plan on staying in the house long term, great, like get that really low rate. But you have to be careful of what the fees they're charging are. Even if they're rolling it in, it's still a fee that's being paid. So always look at, lenders have to give you a loan estimate when you start the loan, and they have to give you a closing disclosure before you sign the paperwork. So always look at that, make sure that the fees are in line. One thing that VA put in a few years ago was some kind of guardrails to keep lenders from churning these Earl loans and abusing customers. So there's rules now that say if the customer isn't recouping the closing costs, I think it's 36 months off the top of my head. If their monthly payment isn't going down enough to recoup the fees within 36 months, you can't do it as an Earl. So some of the abuses in the past are gone, but they're not completely gone. You still have to watch and see what's going on with the rates and the fees.
So Brian, this has been great. Did you have something else?
I was also going to say VA adjustable rate mortgages have come back recently, and I'm getting a lot of junk mail advertising VA ARMs. So that's the other thing you have to watch out for. ARMs are adjustable rate mortgages. They offer a fixed period at the beginning of the loan, but then the rate can change. So there is some risk in that. A lot of lenders that are doing junk mail are starting to advertise the ARMs. The advantage to ARMs is they start at a lower rate. So the rate that they can put in their marketing looks even better than if they were advertising a 30-year fixed Earl. So have to be careful. Sometimes they're very upfront about it, and sometimes not so much. So they'll put, this really great rate on a 30-year loan to try and make you think it's a 30-year fixed. It's a
Yeah.
30-year loan. That doesn't mean the rate's fixed for 30 years. So it can be tricky, and you just have to make sure you're reading the fine print.
No, that's fantastic. So as we start to wrap up, is there anything else? I think we hit a bunch of things, but anything else you want to make sure listeners understand on the VA that we might not have hit on?
Um, just in general, like we said back towards the beginning, the interest rate is important. You never want to pay too much for the interest rate. But with VA loans, it's not the only thing. You really need someone that is going to explain things to you, show you all of your options, help you if you need to try and get that funding fee waived. That's going to help you with that. So someone with knowledge and experience that's going to look out for you. And there's lots of those out there, but that's not everybody. So just be a little bit picky. You've earned those benefits, so make sure you're working with someone that's going to help you take full advantage of them.
That's great advice.
Yeah, definitely appreciate that. So, Brian, if folks want to learn more about you or potentially get in contact with you, where can they do that?
So easiest thing would probably be my company website. It's www.mission.mortgage. No .com or anything like that. Just mission.mortgage. I'm not the only mission mortgage company out there. There are some other ones, but I'm the only one that's mission.mortgage. So um, that's best way to reach me. It's got all my contact info and info on what states I can lend in and other. It's in development, but all the info people need to reach me is there.
Oh, that's fantastic. So, Amy, anything else from you?
No, just Brian, I want to thank you for your time today. I found you to be incredibly knowledgeable as I've had questions in helping clients, realize their refinancing needs. So just thank you so much for coming on today and sharing all of your knowledge. I appreciate it.
Sure, my pleasure. And if anyone out there is watching this and they have questions and you go to my website and see, oh, I don't lend in the state you're looking at, I'm still happy to answer any questions, even if I can't necessarily do the mortgage in your state. So feel free to reach out. I'm happy to help any fellow veterans with mortgage questions.
Awesome.
Appreciate that. So, thanks, uh, everyone else. Thanks for listening, and we'll be back next week or in 2 weeks with another episode. Thanks.
See you
Thanks
guys.
for having me.
To get transcripts, show notes, or more information, go to operationretirementreadiness.com. Have a question or topic for the podcast? Send it to info@operationretirementreadiness.com. Find out more about Amy and Mike at their websites. Mike is the founder of Next Mission Financial Planning, LLC. He retired from the U.S. Air Force and has worked in the financial services sector since 2021. He is a certified financial planner, chartered financial consultant, and a certified college financial consultant. You can find out more about Mike at nextmissionfinancialplanning.com. Amy is the founder of Instar Financial Planning, LLC. She is retired from the U.S. Army and has worked in the financial services sector since 2019. She's a certified financial planner, a chartered federal employee benefits counselor, and a chartered retirement planning counselor. You can find out more about Amy at instarfp.com.